Stockwatch is brought to you by Merchant Waste. Where others stop, we push further. Because we believe business as usual doesn't lead anywhere new. Go beyond with Merchant Waste. Finance, invest, insure.
You're watching Stockwatch this week. I'm Ntauleng Lechela, and joining me to unpack your stock-related questions today via Zoom is Chantal Marx from FNB Wealth and Investments and Devin Shutte from the Rebay Group. Be sure to send your questions through via email to stockwatch@bdtv.co.za, via SMS on 41392 or on X @BusinessDayTV using the hashtag Stockwatch. Chantal, Devin, thanks so much for your time today. Sheesh. You wouldn't say the JSE or All-Share almost broke through a record high yesterday. I was hoping that the optimism here at home would override the sour global sentiment, but that not being the case. How are you viewing local markets at the moment, Chantal? Is this perhaps a chance to get into SA Inc. stocks, considering the optimism about growth and fiscal optimism after the budget update?
Yes, so SA Inc. has been under-owned and undervalued for quite some time. We have seen a bit of activity coming through in the banks. So if you look at equity flows last month in October, we actually saw some really nice foreign flows into the banks, and that has resulted in a bit of a reweighting or a re-rating in that space. But the rest of SA Inc. still looks exceptionally cheap. And I think if you look at the budget and how much better things were than expected from a fiscal standpoint, the fact that bond yields did what they did, I think that it could be a trigger for a more sustained SA Inc. broadly rally.
And talk about a sustained SA Inc. rally. Are you seeing a value in banks, Devin? There's been lots of calls for a buy on Absa, considering that it is, one of the cheaper ones when looking at that sector.
Yes, so that's the short answer. We do still see value. These are terrifically capitalized, well-run businesses. And, Absa as an example, I think they're trading on around a 6 PE, give or take. You've still got a really nice dividend yield, about 8% there. Dividends are still growing around 7% a year. So, if you don't get any of the re-ratings that Chantal spoke about, you're still going to get, mid-teen total returns on a company like that. So that's massively attractive. And I think what you were saying right at the top of the show about the kind of local macro backdrop, I think we've had a great week for South Africa. I mean, the MTBPS really surprised to the upside, which I can't remember last time we've had that. And I think we're starting to see increasing components of what could make for a favorable local environment. I mean, I think global factors are starting to favor emerging markets with a weaker dollar. Our valuations are still not stretched particularly when you compare with the US. The JSE, I think, has got a long way to go. And I think, if we do start to get those re-ratings come in, I think it might go a lot more than expected. And the banks will be prime beneficiaries of that.
All right. So against that positive backdrop, are you seeing positive or rather pockets of opportunity in small cap stocks, medium cap stocks, Devin?
Again, short answer, yes. The caveat being it will depend company by company. Yeah. I think for this local backdrop to really get going, what local investors and increasingly global investors are going to look at is what does the growth profile in the economy look like? And although we did get Treasury downgrading that a little bit, I think there are a number of catalysts that could really spark and that could also surprise to the upside. I mean, if you think about the average kind of small cap company in South Africa and what the management teams have had to contend with over the last few years, for them to generate positive earnings growth in a really anemic environment from a growth perspective and a hostile environment from kind of a policy and operating environment, they've done incredibly well. So if we actually get some of these headwinds turning to tailwinds, like growth, like policy, like foreign investors, I think you could really see some spectacular results there. But you still got to, within that space, look for the quality, look for the companies that are generating positive cash flows, have a good total addressable market, and not overly indebted. And I think there's plenty of opportunity there.
And, thinking about that small mid-cap space, I think of the likes of the Purple Group, which was out with results earlier this week, really doing well. Trading volumes over at Easy Equities, still giving that company a boost. In terms of small cap stocks, small medium cap stocks, Chantal, is the Purple Group one on your radar?
Yeah, so I think with Purple Group, I'd be more selective in terms of when I buy it.
Okay.
Brokerage can be quite volatile. So that I would actually see as a really nice kind of trade within that small to mid cap space. In terms of kind of firm buy and holds, I see a lot of opportunity, particularly in the smaller fintech companies.
Yeah.
So the likes of Capital Appreciation, likes of Weaver Fintech, where you've got an addressable market that is still growing, and where you're not that dependent on anemic local economic growth. At the same time, there are certain companies in the hospitality space, for example, where a pickup in growth can make a massive difference. These companies have very thin cost lines because they've had to be quite adaptable to try and keep to keep things ticking over during this anemic growth environment. So once you see that growth uplift, it'll filter straight to the bottom line. So yeah, hospitality is one of those areas. Motor vehicle retail is one of those areas. And yeah, as I already mentioned, fintech.
All right. So you touched on two sectors where we've gotten questions around fintech and hospitality. I think we've gotten your take on Optasia before, Chantal. So I'll give this one over to Devin. Is Optasia a buy at these levels? I think the last time I checked was trading just above 20 Rand.
Yes, so there's two things, I guess, as with any investment case. There's one is the investment thesis and the business model, and two, what you're willing to pay for that. So, in terms of Optasia as a business model, I think they've been around long enough to prove that they're successful at what they do. I think they're in a very large potential total addressable market. They go for the unbanked, these micro, almost instant loans. I think there is a need for that, particularly in the kind of the commercial micro enterprise space. So I think the business model for me works. I think the valuation where it is at the moment, just above where it IPO'd, which was at the top end of the range, is probably a little stretched. But I think you're probably going to see this as a company that grows into it if they execute on their strategy. So, yeah, to answer the question, would I buy it currently? Probably yes, but I think you are going to have to weather some ups and downs on this one.
Mm-hmm. And then I'll give you, Chantal, another question around the hospitality-like sector. Question here on City Lodge. I bought the share at around 2 Rand post-COVID. Shares are now trading just under 5 Rand. The group still on a recovery path and still posting lower occupancies. Should I sell?
Well, yeah, you've made a really good profit. So I'll take the conservative kind of route here. I still think there's lots of growth runway for City Lodge. It's one of those small caps that I really like because I think that they're doing all the correct things. They were behind the curve when it came to Booking.com and Expedia and all of those guys coming into the market, Airbnb and so on. But that's largely been resolved. You can book yourself into a City Lodge through those platforms as well. But it took some time for them to get there. Then they were behind in terms of their refurbishment and capital expenditure program post-COVID. And they've largely cleared that backlog as well. So in the next 2 years, if you walk into a City Lodge, it's going to be crisp and modern. And the ones that have already been refurbished look really great with a fabulous food and beverage offering that they did not have before. So it's a fundamentally different business. At the same time, I think the push that we've seen in the share price more recently has come from institutional buying. Okay. I see that there have been some big institutions buying that stock over the last couple of months, which is a good thing to a certain extent, but the money can also be a little bit quicker. So my conservative answer is perhaps shave some of that profit off the table, but don't get out of the position completely, because I do still think it's not an expensive stock and there's still plenty of growth runway there.
And I see you nodding, Devin. Do you agree with Chantal? Maybe hold a bit. You can take some profits, but keep 1 foot in at least.
Yes, I would. It's a stock we definitely like for a lot of the reasons Chantal just mentioned. I mean, there's the opportunity to really up those occupancy rates, which drop straight down to the bottom line. And agreed, it's just a really better looking and feeling product than it was. Business travel is continually increasing, and that food and beverage offering has got a really nice margin to it that they're executing well on. And I think the management is, making a lot of actions that are signaling confidence in their future. They've initiated a share buyback scheme.
Yeah.
They're paying dividends again. And so, it's looking in good shape. It operates in a unique position. It knows what it is. And looking a lot more attractive. So, one word hold on to.
All right. So on share buybacks and dividends, a question here. At cycle uptrends, what is more shareholder enticing, Chantal? Buybacks or dividends?
Well, I think it depends on the specific shareholder, because the tax treatment is slightly different for dividends and for share buybacks. You would want the company to buy back shares when the share price is low from a capital allocation perspective. You don't want them to buy back expensive shares, because that money could be utilized in a better way elsewhere. In that case, I think I would prefer the dividends just from a capital allocation strategy. But it really depends on the company. It depends on what type of shareholder you are in terms of what your preference is. I like a dividend personally.
Yeah.
I like the fact that I have the choice to do with that money what I want to do with it. I don't have to reinvest it in the company. I can maybe buy something else. But it's a personal preference, I think.
Then something here about the new lower inflation target. If anchoring inflation at 3% means tighter monetary policy in the short term, does this shift sentiment in the property sector, Devin?
Linked to property, that's a good question. I think this lower inflation point is net incredibly positive for South Africa. I think from a number of reasons. I think what it does is brings us into a low inflationary environment. That means we're all going to, in terms of potential investment returns on bonds, on equities, and that recalibrate. But I think it makes us more competitive and more comparable, and obviously it drives down financing cost for government and anyone lending really, which is terrific. So if the assumption is correct that we're going to have higher rates in the short term, that might have a short-term impact on property. My counter to that would be that I think all of this is potentially growth positive, and I think that the two big drivers in any in a property investment case is what rates are doing and what growth is doing. And I think sentiment is starting to warm to our property counters again. You're seeing a lot of buying coming back into kind of the bigger, more high quality ones. And my sense is that if we start to see economic growth move higher, that's going to be a big positive catalyst for the sector.
Now, Chantal, keeping that lower inflation target in mind, everyone talks about short-term pain for long-term gains, right? Then how are you viewing clothing retailers, considering that we might see the consumer even under further pressure with inflation being anchored at 3% in the short term?
Yeah, I mean, it's a difficult one because there are so many moving parts in this. I think if you are going to see interest rate hikes, which is really not part of our base case, then obviously that would be negative for the consumer. You'll also have inflation expectations coming down, which means wage growth will also be a little bit slower. But I think for the clothing retailers, you'll be able to save on operating costs, for example. With bond yields lower, when you're actually working on a valuation for these companies, your discount rate that you use when trying to price cash flows to today is going to be lower, which means that the valuation is going to be higher. So it's a bit of a push and pull.
Yeah.
I think it's very important to maintain a longer term kind of view on this. It is going to be ultimately growth positive. And I think if it's growth positive, it's going to be positive for the consumer. I am much more worried about online gambling around the clothing retailers than I am about the inflation target, to be 100% honest.
Listen, you're not the only one worried. The CEOs of those retailers are also worried. Now, just looking at some of the updates and results we've gotten out from clothing retailers in particular, Woolies really surprising markets, right? The food business continues to do well. But surprisingly, we are seeing a bit of a recovery in Australia, as well as a recovery in the fashion business here at home. How are you viewing Woolies at the moment, Devin? Is this a turnaround you're buying into, or is it too soon to tell?
Yeah, once bitten, twice shy on the clothing turnaround. I don't know. I mean, if history is a guide to go by, then no. But they've got all the ingredients to make it successful. You know, they've got the caliber of shopper coming into their stores. You know, wants a good Woolies kind of core clothing offering. You know, wants to be able to spend money there and just hasn't been able to do it. So yeah, there is some encouraging signs starting to come out. I mean, also they're able to. They had more sales coming through at full prices, less markdowns. That's good for margins. But the group still heavily relies on that incredible food business.
Yeah.
And yeah, I think you've got to monitor it closely. I think there's a space for them. But I think it all comes down to execution. And yeah, if history is anything to go by, they haven't done that successfully yet.
So encouraging signs out of Woolies, Chantal. Is it a buy at the moment, or would you rather sit back and just see how everything develops?
Yeah, I wish I could buy Woolies food on its own.
Yeah, we all do.
Because I think that would be that would be one that is a no-brainer. I mean, obviously valuation depending. I think within the kind of discretionary clothing retail space, I would be more comfortable with something like a Mr. Price, and something like a Pepkor. I do think that these are more defensive names in that sector. Their valuations don't look expensive at all. If you look at something like Pepkor, the growth runway you have in Fintech, as well as credit adoption within those core retail offerings, I think that's where I'm most excited, or that's the company I'm most excited about, and Mr. Price just for that defensiveness as well. And it's a clean operation. You don't have chaos. You don't have different streams of it. It's clean.
Just shifting focus to the luxury market, Richemont out with numbers today, solid as usual, continuing to shoot the light outs. Yeah, what a good company. And I'm wondering, just looking at Richemont's results, right, even though it was able to report positive results over that luxury slump, we are somewhat seeing a bit of a recovery in that sector. LVMH posted better numbers. Burberry earlier this week also posted better numbers. Devin, is the tide turning for that sector?
Yeah, it does seem like it. I mean, they all came through a pretty tough prior period, and it looks like there's been quite a nice recovery in here. I mean, I think sales were up, was it around 10%?
Yeah.
At constant rates, which is terrific. Really resilient there. Jewelry still leading the sectors for them there. So, yes, I would say it feels like that. I would say maybe a lot of the peak uncertainty from the tariff and the trade wars that we had early in the year are subsiding. I think there's more clarity on that. It's not as much as everyone would want, but at least we kind of understand the state of play. And I think that's feeding into it. And I think there is global disposable income with rates in the US still potentially set to come lower, and, you know, rates being cut in most other regions up till now. So yeah, I would say so. I mean, I think these luxury retailers just continue to surprise me in terms of the incredible brand loyalty that are in these houses. And, you know, people are willing to pay incredible margins to these companies that own those. So yeah, that doesn't seem to go out of fashion, and as a result, it does seem like there is somewhat of a recovery here.
Listen, I wish I was just as brand loyal, rather had the money to be as brand loyal. I mean, a Cartier bracelet would be fun to have. What about you then, Chantal? Are you seeing value in that luxury market? We can even just unpack Richemont's results.
Yeah, I mean, I think what really stands out for me in luxury is that the loyalty has shifted slightly away from clothing, for example, and more into hard luxury. So jewelry, branded jewelry specifically, is performing very well. We saw that coming through in LVMH's results as well. So my preference would be for luxury retailers that are, or luxury goods companies that are over-indexed to jewelry, and Richemont really is that one. So I think it's not only an SA story, but as an international investor, you also want to have your exposure in Richemont in that space. The other area of the market that I quite like is the Veblen good side of the market. So Veblen good, the value goes up because it is scarce and people really want it. So a really good example of that would be a Birkin bag from Hermes. Only a certain number is made every year. The price is very carefully controlled. It's more expensive to buy one online secondhand than it is to buy it in the store, but you can't find it in the store because you need to be on a list. And to get on the list, it's a whole complicated story, but it's very carefully controlled. So that exclusivity really appeals to me, and I think it follows on from hard luxury performing well. So Hermes, I think, is also a company that I really like in the luxury goods space.
It sounds like owning Hermes shares is way easier than trying to get a Birkin bag.
100%.
Let's take a look at insurers before we get into your stock pick. I'll stick with you, Chantal. A question here on your view on short-term insurers, the likes of a Santam or an Outsurance.
Yeah, I like both companies for different reasons. I think both are executing exceptionally well, but they are also benefiting from a very benign short-term insurance kind of environment at the moment, because there haven't been big weather events, there haven't been big fires, the hail has been pretty subdued. So both Santam and Outsurance performing well currently. Outsurance I really like from a kind of an organic growth perspective. The stuff that they're doing in Australia is really interesting. The move into Ireland, I think, is interesting. They're executing well. And Santam is also taking a growth leg up with that Lloyd's syndicate in the UK. So really interesting stuff happening there. I won't see it as an either or. I like both. Perhaps the answer is to have Outsurance on its own and have that exposure to Santam through Sanlam.
All right. And I know you are seeing value in that sector as well. Devin, let's get into your stock pick.
Yeah, so I mean, that worked well. My stock pick is Outsurance this week. And yeah, as Chantal said, got really nice geographic representation across South Africa and Australia currently, and early stages in Ireland. So oftentimes this company surprises people by how big it actually is in Australia. About two-thirds of the revenues are generated out of there. And what they're doing is exactly what Chantal said. They're growing organically. They're doing it through strong brands in those regions, really good service and pricing analytics. And that allows them to maintain those really nice gross written premium growth that they've been seeing. Terrific return on equity. It's in the region of 36%, and I think with the kind of the tech integrations that they're putting in there, and the new growth into Ireland, I think it's definitely one to watch.
Let's get your pick then, Chantal. Where are you seeing value?
You don't get more SA Inc. than Bidvest, so I am going to go for Bidvest. Yeah, I mean, it was a toss-up between the retailers, the discretionary retailers and Bidvest, but I think that if you're looking for kind of an immediate a more immediate positive impact, I think Bidvest would be it. Very well diversified as well, tentacles in almost every area of the South African market. I think the services business has performed very well despite a very challenging economic environment, and any sort of pickup in growth will be very positive for that services business, consumer brands, and some of the more random segments of that Bidvest stable, like automotive, for example. So yeah, doesn't look expensive either.
And you know, I was starting to get worried, Chantal, because you are a resident SA Inc. bull, and for the past 2 weeks you've been going international. So it's great to have you back on board.
Welcome back.
Let's leave it there, Chantal. Devin, thanks so much for your time this afternoon. Thanks to my guest, Chantal Marx from FNB Wealth and Investments, and Devin Shutte from the Robey Group. Do remember that Stockwatch pre-records on a Monday and Wednesday at 1 p.m. and is live at 6:30 p.m. on a Tuesday and Thursday, while Stockwatch this week is live at 12:30 p.m. on Fridays. Keep that in mind and keep your questions coming. For now, that's all from Stockwatch this week, but do stay tuned for lots more coming up right here on Business Day TV.
Stockwatch is brought to you by Merchant West. Where others stop, we push further. Because we believe business as usual doesn't lead anywhere new. Go beyond with Merchant West. Finance, invest, insure.